Oh man, you owe me a lot of money. You don't make bets before I go live, man. It's Christmas out there. I figure we'll try the first time ever. I literally only changed my tie because I saw this comment. You guys are hilarious. But today, folks, I want to talk about the realm of dividends because it's always a hot topic in the Canadian economy. And in this realm of growth, it is incredibly hard to find higher and higher yields. And I'm going to share with you the only three stocks that sit in different sectors that have fairly high yields right now, which are 5% plus, very hard to find in this kind of market environment. But I mean, more or less, like, it's just a peculiar world that we're currently living in. I mean, we've been talking and arguing about, what's going on with like silver and gold right now, because you could have bought an ounce of silver. This is basically by like the kilogram, but $651 per kilogram back in 2008, which was exactly the same price roughly. I mean, in 2004, I mean, you could have bought the dips there in 2022 at around 606. And then all of a sudden it just goes parabolic, right? I mean, you take a look at gold, same story, right? Like gold's, I mean, you could have bought it back in, the peak of 2011 there for $1,800 an ounce, virtually the same price back in 2022, actually for a little bit less then. And now just absolutely, insane, over $5,000 an ounce. But it's happening across the board. I mean, we're seeing platinum absolutely go bananas. Palladium is starting to balloon up. I think a lot of people are just playing off the big names of silver and gold, starting to buy some of these other, precious metal assets. Regardless, I wouldn't chase any of this. I think people really have to recognize what's going on here is nothing short, in my opinion, of pure manipulation. And again, before we get into the dividend stocks, I just want to highlight some of the insanity here because, central banks around the world, they're clearly doing something with their assets, right? Like they're bolstering their central banks because you or I are not moving a $30 trillion market cap. So, considering there is virtually an infinite amount of gold in the ground, there's like trillions of dollars worth of gold in the ground. And I'm sure miners are losing their minds right now trying to get it out of the ground and sell it at these ridiculous prices. But like you and I cannot buy enough gold to drive the price up this high. So like why, when just 2 years prior, could you buy gold for the same price you could have bought it for in 2010? Would you be paying this much now? And the only reason would be to artificially inflate the values of what you own. Like if you already have a crap ton of gold and you can manipulate the price to bolster those assets, that's the only thing I think that's holding up these assets right now. I could be wrong. That's my speculation on it. But in the midst of this winter storm, outside of people looking at precious metals at all-time highs, wishing they bought some, I mean, we're seeing natural gas start to absolutely balloon. And a lot of the northern states getting hit pretty hard right now. Parts of Toronto are getting hit pretty hard right now. Where I am is actually not too bad, surprisingly. I think the downtown and the beaches are getting hit quite a bit harder. Same with some of the northern states. We'll see what tomorrow, the videos that come out, I'm already seeing a few. We'll see how bad it actually gets. But this bodes very well for some of the companies we're going to talk about today for some of the yields, because if oil or natural gas pump up, there's been a lot of suppression in some of the energy plays out there. So, I mean, if you're into the energy side of things, lots going on. If you're a trader, if you're into the growth market that we're currently living through, which is making it excessively hard to find any real yields in the market, you're going to want to watch earnings this week because, my God, we're getting them all the ones that matter to me anyways. ASML, good way to kick off the chip earnings. You got Microsoft, Meta, MasterCard. It's going to be interesting after, Trump is basically going to force them to cut, their interest rates in half on credit cards. So Visa, MasterCard, good ones to look out for. Apple's going to be another really interesting one after the holiday season with the new iPhone sales. There's just a lot going on this week. I mean, you still got some of the classics, AT&T, GM, UPS, Boeing's going to be posting. Lots to look forward to from that end of it. And then finally, if you're like me and you own a lot of US dollars and US investments, it's very likely that though your US investments like Google, like Meta, like the S&P 500, though might be doing well, we're going to start seeing the other side of the US dollar here because there's been a lot of people still dumping USDs, hitting some fairly cyclical lows here now down to 97. I think these are prices more similar to the mid-2010 area, like 2015. I mean, we're trading around that 9,500 range. So we're starting to dip down from the all-time highs where, basically in 2022 when the US dollar peaked to levels not seen since the earlier 2000s. So it looks like that trend has finally shifted away. And again, that probably has to do with the diversification into gold, other currencies, as central banks around the world and countries are really starting to hone in on their own economies. So, that could just be a trend that might not be our friends, because obviously, again, like you, even though my stocks might be going up, they could flatline in the total portfolio value. But that's if I plan on converting my US dollars back to Canadian dollars or any other currency for that matter. But that is the game of currencies. And yeah, so this week, very specifically, I've had a lot of intriguing conversations with you guys. You people on the other side of the screen. I'm always just sitting here rambling to a screen by myself. And once in a blue moon, somebody goes on my website and books a one-on-one. And this week, I had quite a few. And I love communicating with the other half of the channel, because this is where these conversations come up about dividends and retirement, and how you kind of structure that in one's portfolio, right? Because I don't have a lot of it, right? But my parents do. Some people like the idea of it. They like the satisfaction of getting a paycheck every month. They don't like the idea of trying to sell stocks off. And we keep kind of having this conversation about what the weighting should be, and how much equity should one own versus bonds or GICs. And those are all questions you're going to have to yourself, because I just want to start with the very prevalent thing I always bring up, because I'm not a financial advisor. So it's really peculiar when people book one-on-ones and we just talk about their finances, and I'm like, look, don't sue me, bro. I'm not a financial advisor. And I want to start by saying you have to look at your portfolio as though it'll drop 40 or 50% tomorrow. If you are not able to handle that level of correction in your equities, then you might own too much equities. And you have to literally formulate your entire investment strategy around what happens if the markets drop 50% tomorrow. This first way you should look at it. Second way you should look at it is maybe like me and my parents do, which is it doesn't really bother me at all. It's an opportunity to buy more. And the reason it doesn't bother me is because if the market drops that much and companies like Google, which by the way are unbankruptable, actually go that far into the toilet, there's a very good chance you or I will not be having this conversation anymore. And there's a very likely I'm not even going to care to look at my portfolio, because I'll be more worried about my own damn survival at that point. So now that we got the precautions out of the way, let's just talk about the only two. We'll start with the broader based ETFs, and then we're going to look at these three individual stocks that I still like a lot right now that I've been keeping my eye on. The end all be all solution to whether you want more growth or more diversity for me, as much as I look at all these different Canadian ETFs. Again, I'm not talking about option ETFs. I'm not talking about manipulating, just kind of artificially inflating yields through options premiums or something like that. Just pure base, great long-term investments that you're not trying to sell short or anything. I would still go VDY or XEI. But again, we are in a massive growth period right now for most places. I mean, globally, the world is expanding. So yields in a growth market tend to fall off a cliff, and it's not very attractive. Getting a 3.5% yield after the expense ratio, more like 3.3, give or take there on VDY. And, a lot of people think they want to buy this because I own it, but I keep telling people, like, so long as you're comfortable, for every $100 you put in here, 25% of that, or $25, is going straight to, TD and Royal Bank. Where are the holdings in here? Right here. Yeah. I mean, more than that now. I mean, Royal Bank makes up 16% of this ETF, 16.3 almost, and TD is at 10.8. So, I mean, realistically, what is that now? That's like almost 27%, over 27%. So, I mean, you got to be careful, right, with these kind of ETFs. That's why I always kind of just steer people toward XEI, because right now, incomparable. Like I said, when you look at the charts here, VDY, any concentrated ETF with the right stocks will always end up doing better over periods of time. But the reality is if you're somebody in retirement, right, like you don't want to deal with it, because if Royal Bank gets some scandal goes on, something happens like what happened to TD with that whole lawsuit that happened with their money laundering. That could very likely happen. It happens, right? So you just want to be careful. Diversity and wealth preservation, typically in retirement, matter more than growth, because at that point you should have accumulated a decent amount of wealth, and now you're looking to basically, protect that wealth in your golden years of not having to worry about market volatility. But you can still get over a 4% yield here, which is great, like right around a 4% after the expense ratio. And again, you're getting that diversity with well into energy and financials, with energy paying a lot more dividends right now. And it's nice getting a higher bump in utilities, because utilities, I think, give you that stability, and there's going to be much better returns in the utility space in the coming years, obviously because of the expansion of our economies and AI and cloud data, all that stuff. So I think this is a good, well-rounded ETF for most people today that are looking for dividends in Canada. It's monthly, it's a low expense ratio, it's growing faster than its historical averages. The stock alone's up 20% last year. You still get a 4% yield. So this would be like my go-to for most people looking for dividends in the Canadian economy today. Because let's be real, I mean, we're out of those days, man. The glory days of being a Canadian dividend investor are over. I mean, they're done. They're behind us. I mean, for now, anyways. I mean, look at like everybody would run to like the equal weight bank ETFs. I really like HBNK is my favorite, but I think ZEB is just easier to look at because it has a longer track record behind it. And since the banks have just gone on this absolutely parabolic run, you know, banks went from literally paying the highest historical yields throughout most of their history to now paying the lowest. And if you just look at an equal weight bank ETF like this, like the yield is now 2.95% across the board. And this is literally just holding, if you look at the holdings, they're just fairly equal weighted banks. Like you got TD at 17%, Bank of Nova Scotia 16, Royal Bank at 16. So it's literally just the six big banks. And you can only get a 3% yield, just under 3% yield spread across the board today. Like that's sad. Like, I mean, if that's not a definition of a growth market, you know, I don't know what it is, but it makes it kind of annoying because like, you know, most people want to try and lock in a 4 or 5+% yield, and the banks were the place to go at the time. I mean, look at Bank of Nova Scotia. It's the only one right now that has over a 4% dividend yield, which is crazy because, I mean, there was a time where this was getting damn near close to like 7 or 8%, not even that long ago. I mean, you looked at some of those dips back in 2023. What a golden buying opportunity, right? But again, like that's the reality of being an individual stock investor is you're looking for those unique opportunities out there, right? You're not looking for the precious metal stocks that are going absolutely bananas right now. Like you're looking for stocks that have been largely suppressed or stocks that have better values that the market's just not paying attention to, that typically have those higher yields. I'm sure you guys know half the stocks I'm about to talk about, but there's still three that pop up a lot for me. If I was in the financial space, the only stock I'd want to buy individually right now, if I'm looking for a safe, reliable, high-paying dividend, that would be MCAN Mortgage. This one's not really suppressed. It has run up on the back of many of the financial stocks running up. Actually, very similar run up. I mean, it is trading up 40, 50% from some of the lows back in 2004, 2003. Regardless, you're getting a 7.3% yield. Now, for those unaware, this is Canada's largest private mortgage lender, and they offer some other financial products, but mostly just corporate and private financing. People probably looking for second, third mortgages and homes. This company, I was very questioning the reality of higher interest rates and how bad this company could get hit. And then the reality kind of set in that people that go to these companies are already used to paying higher rates. And, you know, some of their mortgages are insured as well, but they're almost $1 billion company today. But for a 7.3% yield that is paid monthly as well, it's not as crazy as it used to be. I mean, again, you go back and you could have capped in almost a 10% yield on this guy not that long ago, but still to get over a 7% yield on a company trading at a 13 PE, it's got good growth, still grows the dividend, pays special dividends, not a bad idea. So on the flip side, I think Enbridge still remains, from an energy perspective, one of the best stocks for dividends anywhere in the world. I mean, it is the lifeblood of the Western world. If you look at it's literally just the pipeline company that runs oil all the way from like Alberta all the way down to like Texas, basically, and through a lot of different areas. But the reason I like it so much is because it's diversified heavily into the natural gas side of things. Right now, paying a 6% yield. These are the kind of stocks you just buy when they start flatlining, and the second oil bumps up, they start doing exceptionally well again. But the dividends hyper reliable next to Canadian Natural Resources. Canadian Natural Resources has one of the largest natural gas deposits in the world, some of the largest oil deposits in the world, oil deposits that should be good for another 40 plus years. Their yield is just around 5%. When you catch it on the dips, easy 5%, but now it's popping up because natural gas is popping up. And again, I keep saying that about these energy companies. They're great to just sit on the yield and wait for, the either oil, natural gas to start doing its moves, and you get winners like this. So there's some cyclicalities to the movements, but they're very reliable companies. So I think there's some hope and opportunity here for these things to start popping off again at some point soon. I've said this about Canadian Natural Resources, and my biggest bull thesis, and I'm a little bit more bullish on Canadian Natural over Enbridge, purely because I should pull it up in the balance sheet, but I'm just trying to do a broad overview because I've talked about these before. But if you go look at their recent earnings, their production levels are talk to anybody that works for these companies. It's kind of interesting. They are producing more oil. Their oil and natural gas growth rates are absolutely insane. Let me just see if I can find it here. I think this is what the Canadian Natural Resource Limited announcement. I just want to look at their earnings real quick. Do we not third quarter? Let's pull up the third quarter here because it should be in here if I am not mistaken. But what you want to look at is right here. Look at this. Look at how insane this is. So their production. So what we have here is we've got crude oil and NGLs and the equivalent productions of barrel oil equivalent per day. And look at the growth rate here. So right here we've got basically year over year. And you take a look at 2025 versus 2024. Look at the barrels of oil equivalent per day, 1.6 million versus 1.36. Like, that's crazy. Look at the natural gas production here, 2.6 over 2. Like, I mean, these growth rates are insane. Yet the stock hasn't moved at all. So it's just like you're watching these massive production and scaling going on during a period where the stock price is doing nothing. So very mild movements in natural gas and oil will have major impacts on something like Canadian Natural Resources earnings. So because their production's scaling so much, it doesn't really matter that oil's coming down because it's keeping their earnings fairly baseline. But even still, I mean, their earnings are growing, right? Like, they're doing a pretty good job overall. I mean, look at the 9-month end, 5.5 billion versus 4.9. So I think it's just one of the best Canadian companies that exist. And again, it is a very good stock to just get exposure to through obviously VDY. XCI, you'll automatically get exposure to companies like this. Enbridge is 7% weighting here. Canadian Natural Resources about another 4.6%, and VDY, not sure where they sit in XCI as an example here, but I'm pretty sure, yeah, Canadian Natural Resources is at 5%. Enbridge in here, another 4.8. These are great companies to get exposure to. Super awesome. So outside of, you've got your financials, you've got your energy. These are kind of the two go-to dividend places for people looking for higher yields. But right now, I think, again, when we're talking about like the more suppressed markets, I mean, oil, energy stocks, I wouldn't say they're suppressed. I mean, the financials, you can find some, little nooks and crannies like the MCAM mortgages of the world. But when I'm looking at suppressed dividends right now, and I'm going to show you one chart that makes me really bullish on just the only Canadian REIT that I like. Like I said, I'm fighting myself on buying it because I own a property in Toronto and I have a lot of Canadian real estate exposure. Most Canadians are overexposed to real estate here because, they buy a house, it's gone up stupid in value. A lot of Canadians, their retirement rely on them downsizing properties and stuff of that nature. So I usually don't advise or recommend, not as financial advice, obviously, people over leveraging into Canadian real estate. And I've said it's been a terrible sector. I hate it. A lot of manipulation going on, but there is one that I think is still fairly well managed. And I know a lot of people like the RioCans of the world. I think RioCan, okay, the malls are questionable, but at least they own a lot of square footage and very valuable real estate areas. But for free cash flow alone, we're starting to see like a recovery in like the industrial sector, which we know is growing. You drive down the 404, go up north to cottage country and just look at the amount of, crazy amount of just logistics centers that have gone up. So, I mean, we're starting to see a bounce in recovery in a lot of things like Granite Real Estate and Dream Industrial. But when it comes to just pure diversity and exposure, I still think Canadian Apartment Properties is trading at a severe discount today. And I mean, you can kind of see it. They did a good job on their PowerPoint presentation here when it comes to like historical performance versus their funds from operation and basically their NAV value. And for those that don't know, Canadian Apartment Properties gives you the most exposure to like Canadian just retail, like residential rental units. And I mean, you look at their funds from operation because they've been lowering their debt and they've been selling properties off. So we've actually seen their net asset value go down per share for the first time, and their stock more or less followed their net asset value and their funds from operation. But now, even though they're lowering some of their property, exposure and paying down some of their debts, which they have one of the best, debt to asset ratios of any company out there at 30%. Somewhere in the 30s, like very well done. But their funds from operation have continued to go up. I mean, their FFO trading at 253 and their net asset value is more or less stagnated, but the stock is trading well below at this point. So I keep saying like, this is a recovery play, right? Like everything is starting to flip back to the other side. They've done a lot of the restructuring. Interest rates have come down. We're going to start seeing the other half of what I call the interest rate recovery plays. And these are your and I've said this again, even in the US, like it's a lot of the SCHDs of the world, a lot of these more traditional dividend ETFs that don't market cap weight companies. You tend to just get exposure to old dinosaur companies. And that's not necessarily a bad thing. It's just a matter of a lot of those companies tend to come with a lot more debt. They're a lot more sensitive to interest rates. And now I think that we're getting to the other side of it, starting to in the US. I think we're going to start seeing more interest rate cuts. But in Canada, we've seen some pretty severe interest rate cuts, and we're probably going to see more into the future here. So it's likely that these companies that haven't seen a real big bounce back yet have the real opportunity to, start seeing a great recovery and a rebalancing in some of their mortgages, which will tend to increase the funds from operation into the future, which are already doing pretty well with this company. So I like this stock still personally. From the REIT side of things, when we look at some of the other sectors, and the only other sector that interests me 9 ways to hell is obviously the telecom sector, which everyone hates right now. Obviously, I kind of dance around this one. I haven't really bought into it too much just yet, but I still think it's more than likely the bottoms are in. There's only 3 major telecom giants in Canada: TELUS, Rogers, and Bell. I think Quebec Core, there's some other small ones coming up, but we like to focus on the majors because they pay the biggest yields. And basically, you have there's a few stories going on across these, right? Like basically, Rogers had the biggest recovery because they did the best job paying down their debt and readjusting quicker than the other companies have. But I think it's a sign of what will happen for the other companies. I don't like Bell. I think Bell was the most mismanaged. I don't like their media assets. I think they're garbage. I hate old dinosaur media. I just like YouTube. If you want Netflix, sure, but forget traditional media. I don't think they're going to do great with it. I wouldn't touch Bell with a 10-foot pole because of it. But when it comes to something like TELUS that is starting to recover here a little bit, and the returns have actually been pretty decent if you bought it at the beginning of the year. It's trading up 5%. The yield is still around 9%. They're not cutting the dividend. They're pausing it while they restructure and pay down their debt. And they've gone through, I think, the biggest hurdle, which was the layoffs. Finishing off some of the they still got to pay out a bit, but I mean, they're paying down a lot of the restructuring they've done. And now interest rates have come down. We're starting to see an increase in their net income, their funds from or just basically their cash flow is starting to increase again after they've gone through some of the wicked period. So again, I think these are stocks that people don't pay attention to. I think they have great yields. I think you can buy them and you can sit on the yield. And like I said, with these 3 different industries, you've got TELUS here. If you wanted to own, even Rogers, I still think is pretty reasonable, but TELUS still remains my favorite. It's a cherry on top of the cake. If the stock starts to recover in the next 3 to 5 years, you're doing great. From a real estate standpoint, if you love real estate, like I said, you're getting a 4% yield right now off Canadian apartment properties, the highest yield that's paid out in virtually like 15 or 20 years. You're getting paid monthly. You throw in your TFSA, a little bit of it. You get the best diversity across Canadian real estate. It's got great fundamentals right now. It's a great recovery play, trading way too far down. Energy plays right now are going to do great. I think you're going to see natural gas do well through the winter. Oil starts to do even slightly well. These stocks are going to pop up. You get a great starting yield of 5 to 6%. You sit on these as well. You're not doing too bad. And again, I can't foresee MCAN doing terrible here at a 13 PE right now. Trading at a reasonable value with a 7.3% yield. That's if you were chasing individual stocks, perhaps over the banking sector, where you can't get good yields anymore. And I wouldn't be surprised, and we've been talking about it, why MCAN hasn't been bought out yet. I feel like it's a good acquisition story for one of these major banks. I could see that happening at some point in the future too. Time will tell. But let's get into your comments here, guys. I know I've kind of been just focused on getting through this, but I know a lot of you guys have probably had a few questions, comments. So we'll kind of stroll back up to the top here and see what you guys had to say. Kyle wearing a blue tie. This isn't the darkest timeline. This is the darkest timeline. Yeah, I know. This guy bet me though, man. He owes me his whole portfolio now. So what do you want me to say? Hello from Windsor. How's the weather in Windsor right now? I can't imagine it's too delightful. It's been abysmal ever since I've returned from vacation. I want to leave again. I don't know why I came back. We met a nomad on our flight back, a guy from Mexico that literally just goes month to month living in different countries. And I'm like, why are we at home? I'm like, we could do that. I mean, the problem is the Eastern time zone thing, and you'd have to kind of go south or stick somewhat within a few hours, maybe get away with Europe, but still, why are we here? I should just leave. I don't need to be here. I could do this anywhere in the world. Central banks are buying and keeping paper. Contracts are worthless. Yeah, more or less. China's doing things. Yeah, I think there's question around, new world currencies, China trying to back the yuan. I mean, there's, I don't know if it's a conspiracy. I haven't looked too deeply into it, but across Europe and a lot of major banks are diversifying gold holdings to start backing currencies. I don't know if that's true. I don't know if that's some made up conspiracy thing that's just been circulating the internet, several months ago, and now no one's really talking about it. I don't know, but it's central banks for sure. I mean, gold's trading at what right now? Like, what's the market cap value? Gold's market cap value today. It's what, 35? It's approaching like $40 trillion. Yeah, like I mean, it's the largest asset class in the world. How do you balloon a $30 trillion value? Like, think about how hard it is to get Google and Nvidia. Like Nvidia right now is struggling to get up. Like, and it's a $4 trillion company. Now imagine 10 times the size of Nvidia, the largest publicly traded company in the world, and it is just going effing to the moon. Like, come on, it's insane. It's scary, is what it is. Like I wouldn't touch it with a 10-foot pole. It scares crap out of me. But I don't know. We'll see what happens. I got a little bit of precious metals, not enough to care about. I don't like them personally. You got to trade them to make money. Seriously, Young and Eglinton, the cars in our parking lot are under snow. You can see the roof. So yeah, where's my phone at? Over here. Let me grab my phone. I'll show you a quick photo here. Yeah, I mean, it's kind of interesting because up where we are, we got a lot of snow in the morning. We're like GTA, like we're more Markham area, but my buddy was asking me how I was holding up because of how bad he was seeing the weather, and he was sending me photos of like the beaches in Toronto, which I don't know how well you can see that, but yeah, some of those cars, man, they're just getting pelted right now. So we need to see what the aftermath. Yeah, CNR I didn't mention too much. Canadian National Railway, because I'm looking for things that are yielding over 5%. And I think if you're looking for a good value play, I think Canadian National Railway is a staple for sure. I think you could run to that one. I just don't think a lot of people want, like I said, I'm an income and growth guy. So I think if you're looking for 5+% yields, you can get a bit of income and growth off the stocks that I mentioned. But I think if you're looking for foundational stocks that you just care more about value than yield, which is a guy like me, like I don't care. Value to me is not dividends. It's whatever I think the stock value should be, and I don't care if it pays a dividend or not. But I would put Canadian National Railway in that bucket, like as a great overall buy. Time will tell. Yeah, C&Q is probably one of the best. TELUS, Take Two. What's the third? So yeah, I actually I said I was going to wait to buy Take Two, but I did buy a bit of it. I think it's a highly speculative play, but we're all sitting here trying to figure out what the math is behind Grand Theft Auto or GTA 6. And I'm not like, I don't know how big I'm going to make the position. I only bought like a couple $1,000s worth of it. I just want to keep it in my portfolio so my eye stays on it, because if I don't own it, I tend to let it fall to the wayside. So I did buy a bit of it, but that's just pure speculation, guys. I mean, honestly, we don't really know what's going to happen with that. It's still pretty far out. Kyle, I'm about income in retirement, buddy. Yeah. So, I mean, here's what I'll recommend. If you are in retirement, this is exactly what I did with my parents. And I think it's a healthier way of approaching a portfolio in retirement. Obviously, you got to look at the tax structure. And typically what the first thing if you haven't figured out the tax structure of your TFSAs and your regular brokerage accounts, I highly recommend going to Wealthsimple's tax calculator. This is like the very first place I would start before even talking about dividends, because you really have to understand basically what the tax structure is going to look like between your diversity of income. Because obviously you don't want to be 100% Canadian income. Like, you want to make sure you got some diversity into like US assets and global market dividend ETFs. Like, you're trying to diversify that income stream as much as possible, because it's going to give you the best wealth preservation. And to be frank, I mean, like, let's be real. The foreign dividend stocks have crushed everything. Like Canadian dividends, you look at things like ZDI. I think VIDY. I think that's another good go-to right now for foreign dividends. I mean, the yields aren't like super high, but look at the returns. I mean, look at this right now. VIDY is up, 29% in the last year. And that's just, an ex-North American high-yield dividend ETF. And these are the things you got to look at, right, and consider. But before you do that, like, I always try to explain to people, like, you're not always better off owning Canadian dividend stocks in your TFSA. Because if you're not making any money at all at your job and you're just collecting maybe a pension, but like, to put it in perspective, if you make $50,000 in eligible dividends, which are Canadian companies that make 50% of their income in Canada, which is your VDYs of the world, your XEIs, guess how much tax you're going to pay? $600. Whoop-de-doo. Like, and it's the same with growth stocks, right? Like, if you look at like capital gains, if you made $100,000 in capital gains, you're only going to pay $7,000 in taxes. And even ineligible dividends, like let's say you made 50 grand in ineligible dividends, like you're still going to only be paying a couple grand in taxes. So like, I think people overthink what they're doing with their TFSA and just buying Canadian stocks, but you're arguably better buying US stocks, things that yeah, you're going to have to pay a 15% withholding tax on, but guess what? You're not going to have to pay the regular, the ineligible dividend income tax on top of the withholding tax. So, I mean, to save that, losing that 20%, having it outside of your TFSA or RSP, you want to make sure you're structuring it so maybe more of your foreign stocks are sitting in your TFSA. It's just usually a recommendation that I would say. And then from there, what you want to do is you want to ask yourself, how much income do I need to support my lifestyle? So you got to take a look at your CPP, whatever pension you're getting. And then you say, okay, now that I've got the tax thing figured out here, what are the safest possible investments that are going to diversify me into wealth preservation that will meet my basic needs? So that's why I'm mentioning XEI. You could look at VIDY, SCHD, ZDI. You want to take a look at a bunch of different global market dividend ETFs, and then you want to figure out how much you have to hold, where you have to hold them to maximize the tax advantage. And then just say, hey, if I need to make 40 or 50K a year, get there with those ETFs. And that's your like base. That is your, okay, that's my FU money set up. Now I need to take the rest of the capital I have and say, okay, I can't shy away from growth either. So let's diversify this capital between high income, maybe take on a little bit more aggressive risk with even option ETFs. If you want to make 5 or 10% of your portfolio, like maybe a bit more aggressive, go option ETFs. You could look at individual stocks like the ones I'm mentioning. You can go take a look at, you want to take a look at growth for sure, a Google stock. You could look at VFV, maybe even the Qs. And that's where you want to make sure you're really diversifying into getting that growth and income. You want international growth and income. You want a good mix of all of those things. But it really comes down to how much capital you have to invest. Are you still working in retirement? I mean, these are all questions you kind of have to formulate. And it also includes like an RSP deduction plan, right? Like you got to pull that money out of your RSP. Maybe you take that money out, pay some of the tax and just put it into VDY. Focus on using that money to buy back Canadian dividend ETFs. I mean, you got to just formulate. It's easy and complicated. That's the reality of retiring, right? Because for me, like I love self-managing my portfolio. My portfolio will look like this regardless. Like my fiance and I, we invest very similarly. Like our portfolios, like this is our idea of retirement. Like if I want capital, I could sell some S&P 500. I'm not a guy that cares about clicking the sell button. If you haven't figured that out by now, I used to flip flop a lot. Like selling stocks, not the big deal to me. So I don't mind collecting a little bit of dividends. If I need to use the dividends, I can. If I have to tap into a little bit more, I don't mind either. So hopefully that gives you a little bit of insight from that. Hey, Kyle, why not a material CAD ETF like XMA? I like a lot. Yeah, I mean, let's take a quick look. The material side of it isn't something that I'm paying attention to because it's just going absolutely bananas. But obviously now is the time. I mean, if you wanted to play into the material space, let's take a quick look. So yeah, how's this one doing? It's up 21% year to date, guys. We're not even a month into the year and it's already giving you an annualized return of that of VDY in a whole year. Look at that. So like I said, the reason that I don't buy this stuff, and my guess is because it's highly, highly concentrated in gold stocks right now, probably uranium stocks. This is a very hype sector at this moment. I don't like hype. I buy things like Google Medic. I like buying things when people don't give a shit. That's like that's the only way I feel like I can make good money in the market, right? Or cost averaging in the XEQTs. Like, I mean, what else are you going to do, right? But let's just see what we got in here, guys. Yeah, I mean, look at Nico Eagle Mines is 15%. Barrick is another 11%. So, I mean, basically this ETF, you are just banking wheat and precious metals. You're banking on gold and silver. So if all of a sudden gold and silver collapse, which by the way, there's no guarantee they don't. They did after the 2000. Think about 2008. Think about the severity of the real estate crash that went on. Gold absolutely ballooned. And then what happened? It crashed. I'm like, these things are doing something unlike any time in history. And I don't know if it's a long thing or a short thing. But when there's this kind of volatility, it's gambling. I don't want to gamble. And that's what this ETF is right now, guys. I mean, these are great companies, don't get me wrong. And you're getting a good diversity in something like VCE or like, the Canadian markets as it is. This is the whole reason the Canadian markets are up so much. But I wouldn't want to be this concentrated unless I had a stop loss and a plan to just make sure I'm not like going to get caught on the downside. Because trust me, man, it's you guys, you guys saw like the crypto crash of 2022. I mean, you guys must have seen crashes before. Like this stuff can turn at the drop of a dime. So, I mean, just be hyper aware of that when you're buying ETFs that are like pretty much fully concentrated in a handful of companies. And this is the same risk with VDY, by the way. I mean, like I said, that's why I don't make VDY more than 30% of my portfolio, because if Royal Bank for some reason crashes tomorrow, like VDY will get hit really hard. So just be aware of that stuff, right? Like you got to understand what you're doing here. But again, like probably one of the best ETFs to own right now. Set a stop loss, man. Just protect yourself and ride it to the moon, because it's probably going to keep going up. Because every time I say I won't buy it, it just goes higher. MCAN is where all the money in CMHC goes. Nice. Considering buying REITs that are beaten down, they have a recovery soon. Thoughts? No. So again, I would avoid the Canadian REIT sector like the plague. Focus on the U.S. REIT sector. U.S. REITs are going to do far better in a lower interest rate environment. They're way more diversified. They're better managed. Canadian REITs have been garbage managed, horrible, most of them, terrible management. Like I said, I've been just eyeballing them and watching them. And I mean, like, I can give you a ton of examples. Like, we've been in the greatest growth period in real estate in history. And look at something like True North Commercial REIT. This was like one of the go-to staples for people in Canada. And look at this thing; it's flatlined. It's basically just dead, right? This was like a go-to. It was a huge, a $500 million REIT at the time. It was stable for almost 20 years, and like real estate has gone to the moon. I know it's correcting now, but since 2000 and whenever this came public, like real estate was crushing it. This is what most REITs look like. Like look at Allied Properties, and I know some of these numbers are starting to look good, but I just don't trust management. Allied Properties was another really big one. I mean, this was one of the biggest office REITs, and it got absolutely slaughtered. Look at it. And I know the numbers, like I said, you can look at the numbers right now and they look a lot better because people have given up on them, but I just don't trust management. So I'm looking to see who is performing better at the management side of it. And when it's just purely management based, I think Cap REIT's getting the gold medal. I know I'm looking at them and I'm like, man, they've restructured their debt. They're one of the they paid a lot of stuff off, sold off some probably their not so great properties. You get a lot of diversity in it. A lot of protection. You still get the upside of turnover in tenants because their payout, what they're charging tenants, I think on average is $1,800 a month right now because of a lot of land locking that goes on, or the government basically only allows to increase rents 2% a year or whatever. But still, H&R is another one a lot of people talk about, and it's done okay. Yeah, H&R is another big one a lot of people talk about. Have you heard about the issues with the Japanese carry trade again? Possible big dump coming this week, maybe. I think let's take a look at futures right now because I think futures are in the toilet just because of the whole stuff going on with Trump. The whole ICE stuff that's going on. You've got the Canadian tariff thing. Futures. Let's take a quick look here and see what's going on real quick. I'd rather the markets crash. I hope Trump keeps stirring the pot. I mean, this whole turmoil going on in the U.S. is only better for the markets. Let's be real, man. I'm a guy that wants to see it come down. I don't want to see it go up. I'm not done buying. Yeah, I mean, futures right now aren't terrible, I guess. S&P's down 0.24%. I think a lot of stocks are looking to be going green. People are just so bullish. This market is so speculative right now. I mean, Nvidia's up. People just don't care. We're in a bull market. Everything goes to the moon. Can't lose until you do. But for right now, you can't. So, yeah, just buy gold. You'll be fine. India is selling a lot of USD. Everyone's selling a lot of USD. What about EMP? A stock is down 20% that doubles their dividend every 10 years. What is EMP? It sounds familiar for some reason. Let's take a look at another dividend gem here. Did we just discover another Empire company? I think I've heard of this. What does this company do? Their yield is only 1.9% though, so it's not really in the higher yield, and they're not really trading too much off some of their crazy growth. Empire is up still pretty dramatically from the lows. I mean, from the 2023 lows, down 20%. From the recent, good company by the looks of it. Empire, Canadian conglomerate, engages mostly in food. That's why I probably heard of it before. It's a food company that supplies to Sobeys and some probably different markets out there. Food markets are stable. There's a food REIT in the U.S. I can't remember what, or is it a Canadian one? It trades on the Canadian market. What is it called? Canadian food REIT. There was another one. It's a smaller REIT that I followed for a while, and I took it off my radar. State Grocery. That's the one. How's this one doing? Yeah, this one's been doing pretty good too recently, right? Like it's stable. It's fully recovered from the lows now. Pays 7.5% yield. It's a U.S. REIT, but I think it trades on the Canadian markets. So this is another interesting one to look at, I think, as well. I forgot about this one. This might be a good just REIT in general if you want a good sustainable yield. It was a good one to buy on the dips, though, when it was back at $11-10. It's definitely done a good job recovering. But again, you got to look at sectors with good management. Regardless, CPP definitely, yeah. CPP has underperformed index. Only managers getting fat fees. To be fair, I mean, CPP's done a good job. I think their growth rate was for the last year was what? For those that are unaware, the Canadian pension plan is managing like what, $400 or $500 billion right now, and I honestly think it's one of the best managed funds in the world. CPP rate of return for 2025. I did a video on this, I think, before I left. I mean, their fund achieved 9.3% in net fiscal returns ending March 31st, 2025, with net assets surpassing 700 billion. Which is crazy. Like, I know a lot of people like to shit on CPP. Their 10-year annualized is around 9%, but I'm sorry. Like, this company is managing our entire retirement, and it is the best managed fund in the world. You got to think, when you have $700 billion, you're not putting it in the S&P 500. I'm sorry. I mean, they own some of the most premier real estate in the world. They own over 50, the controlling interest of the 407, which, by the way, the 407 is the most profitable company in Canada. Their margins are that of NVIDIA. 80% are their gross profit margins. And they own 51% of it. Like, when you look at the assets and they bought NVIDIA and Google and all those stocks like years ago. Like, they're still holding their original NVIDIA shares from like several years ago. I swear, if you do a little due diligence on CPP, I think you'll be rather impressed, because like getting a 9% return on $700 billion is not a bad return. I know when you look at the markets that are going up 20% in Canada and 13% in the US, I get it, but you're talking about, like, you cannot lose that money. Like, you cannot afford to lose it. Like, it is the Canadian retirement system. So, I mean, like, you have to diversify the shit out of it. And the fact that they bought what they bought and the assets they own, I'm pretty impressed, because to be fair, it is like the only major toll road in all of Toronto, and they own it. It's like, it's a fucking cash machine for them. Bassam hates Canadian REITs. Yeah, you should. He's the guy that made me hate Canadian REITs. I'm trying to do a collab with him right now, actually. I just talked to him today. He's probably one of the most intelligent CPAs I've ever met in my life. Super fascinating guy. You should go check his channel out. But we'll do a collab. I'll link his channel. I'm heavy in divvies and HHIS. What's your opinion on them long term? So long term, they're stupid to own because you're shorting yourself the returns. This is why I don't like covered call ETFs, because the ones that offer higher returns tend to employ leverage, which is also dumb because you get all the downside but none of the upside when the markets do end up recovering. I've done so many videos hating on these things. I think in retirement, if you're using income today, you can make them a percentage of your portfolio, and there are some good ones. I know HHIS has been doing pretty well, but to be fair, I wouldn't make them more than 5 or 10% of my portfolio, because you still want the growth, and we are in the greatest growth period in human history, and you're selling yourself short. It's like the misty investors of the world, right? Like, it's like you're bullish on crypto, so you're going to sell the shares when they pay off. That's what you're doing. Like, if you understand covered calls, right? Like, why would you buy Bitcoin to just sell it to somebody when it goes up in value, and that person you're selling that covered call contract to has none of the downside risk? You take all of the downside and give up away all of the upside to collect a small premium. It's like, what is wrong with you? You need to be slapped upside the head if you think that's how you should be thinking. It's so dumb. It's so dumb. What else is going on here? How do you feel about DOL? It's been one of the greatest Canadian companies in the world. I used to own it, sold it. I was an idiot. Should have held it long. Recession-proof company, trading down 6% year to date. But I mean, I couldn't buy it. I think it's too expensive. It's one of the most expensive companies. It trades at a 40 PE. And look at this thing. It's just a behemoth of a Canadian company worth $52 billion. I don't like retail, though. I hate retail. I mean, go walk through some of these malls. You'll start hating retail really quick when you watch how many watch stores, jewelry stores. I mean, what Toys R Us is gone. What else is gone? Decathlon. Like, there's so many majors. I mean, H&M, or was it H&M? Not H&M. What's the other one that just closed? The big one. They're all closing. I mean, I hate retail. The dollar store still got a good little yeah, Adrian hates me. He probably does. I do a collab with him, bro. I don't have any beef. I don't care what he does. I just think it's a foolish way of investing, and his returns speak the truth. I mean, look at his returns, and they're falsified returns, because a lot of times these companies, like when they show the dividend, a lot of those times those high yielding option ETFs are just returning your own capital. So sometimes they don't make as much option premium as they want, because guess what? When they have to sell the option, they have to take the cash and buy another option premium. Like, they have to buy another option contract. So sometimes they just pay you out your own capital. And that's where you get the erosion of NAV, right? Like the NAV erosion. So what's really funny is they show you dividend income. A lot of time that's not actually a return. It's just a return of your own capital. So like, you can't even properly calculate the returns of his portfolio. And God knows, like, over a decade, the worst returns you'll ever get in a portfolio is by owning option ETFs. And that is just a fact. It is a reality of covered calls. So if you're a long-term investor, you should not be focused on option premiums unless you're writing them yourself. I mean, my go-to solution is if you've never written an options contract in your life, do that long before you ever touch a covered call ETF, because everybody I know, literally everyone I know that does their own covered calls refuses to pay a fee to a manager of 1% to write a covered call contract at one click of a button. So, I mean, it's really funny because everyone swears by covered call ETFs, but none of them have ever written their own covered call contracts. And everybody that writes their own covered calls swears they'll never touch one of those ETFs. So it's kind of like hilarious to me at the perspective of those terrible detriment to the investing community ETFs, the dividend traps. They do well, and then that's the problem. Some of them do great, and people are going to keep saying that they'd rather own them because they make money, but they're just making managers rich. I work for Bell. Should I move all my stock at work to my TFSA? So how much? What do you mean stock? Like, are you getting paid out from Bell in option or just stock options? Because if you are, that's another interesting conversation I've had with a bunch of people. But I work for Bell, so should I move all my stocks at my work to my TFSA? Yes, and then you should, if you can sell them for a profit. But I think the reality you're going to have is, well, I can't imagine you're up on them, so probably is a good time to move them because you're not up on them. I can't imagine you're up a lot on them. Not like, I'm sorry, I'm not trying to be rude, but like the big problem that if you're trying to transfer stock out of a regular brokerage account into your TFSA and you're green, you still have to settle the capital gain. So, I mean, that was a problem we were kind of dealing with moving stocks around when we purchased a piece of real estate, is we wanted to shuffle some of the remainder stocks we had back into our TFSAs, but unfortunately, you can't just do that. I think they force you to take the cap gain on it. But in your position, if you're not up a lot, yeah, I would instantly, if you haven't maxed out your TFSA, man, what are you doing? Get all the stock and money you have and pile it into that tax-free income in perpetuity for the rest of your life. You're missing out, baby. This is 0.27 share at the moment, HHIS. Yeah, we can pull it up if you want to take a quick look at it. I know it's doing well. There's a lot of good ones. My parents own some. Like, I like Devo in the US. There's a bunch of good ones. This one I think is up, in the last year. It hasn't gone actually anywhere since really IPO from a stock-based perspective. But I mean, let's take a look at the, I just remember the Misty people of the world. Like, it was just people pumping all the dumb stuff. This one probably does it have a track record yet? No, actually I would avoid this like the plague. Sorry, I thought this was a different one. I think you were talking about like HMAX, some of the ones against the banks, but this is garbage. These are all growth stocks, horrible growth stocks that are overvalued for the most part. I mean, Tesla's in here, Palantir's in here, things that I wouldn't really want to touch. But yeah, these are all growth stocks. You do not want to write covered calls against growth stocks. It's the stupidest thing you'll do. And someone's still going to argue with me why it's such a good idea. I don't know. You guys do what you want to do, but I wouldn't do this. This is just stupid. I wouldn't even look at the dividend yield. I don't want to. If you're buying growth stocks, you're buying them to get growth, not to collect a yield, not to collect a premium. I'm just saying. Seems the companies people work for don't invest well. Yeah, usually how it goes. Anyways, folks, we'll take a look at one more comment here. Any love for VGRO? What is VGRO? I've heard of that one too. The Vanguard Growth Portfolio. So this one's probably a pretty good one. It's probably similar to the Qs, but it's Vanguard's version of it. I wouldn't be surprised. In the last year, it's up 14%. I know growth has been lagging the broader markets thanks to precious metals and commodities. But yes, I think in everybody's portfolio, depending on your concentration, the tech already, which for us, I'm a guy that gets all my tech exposure through the S&P 500, and then we buy individual tech stocks because I don't want broad exposure to NVIDIA. I don't want broad exposure to Tesla or Palantir. I want to get broad, concentrated. Well, I don't want broad. I want concentrated exposure to tech stocks I believe in. And I've done a very good, successful job at picking them at good times. So I'm going to keep doing that because it's worked for me. But for most people, I get it. You should get exposure to growth companies like this, or growth stocks. And this one looks pretty good, actually, because it's not concentrated. So this is probably a better one, in my opinion. Yeah, actually, this one's pretty good. Look at this. You got NVIDIA, Apple, Microsoft, Royal Bank, Shopify, nothing making up more than 2%. It looks like it's a global market ETF as well. So you're getting exposure to Japan, probably getting some Chinese stocks in there. Yeah, this one's actually pretty decent. The yield's probably higher on it as well, right? Yeah, the 12-month is 1.88. Yeah, this is a pretty good ETF. Yeah, you inch up a bit of higher yield, you get more global diversification. Great ETF, actually. This is probably a go-to. Trades on the Canadian markets. What's the expense ratio on this guy? Yeah, good recommendation, actually. I don't talk about this one too much, but this is probably a really decent ETF overall. What was the expense ratio on this guy? Yeah, 0.24%. You're doing great from that side of it. Yeah, I mean, yeah, couldn't go wrong with this one. I think this would probably be a good diversified solution to growth. Great returns over the last few years, 17%. Not bad, not bad, not bad. Anyways, folks, second live stream of the year. Appreciate y'all stopping in. We'll finish up with this. I heard you just mentioned Toronto. Would love for you to be my mentor. Lol, I want to start investing, but I have no idea where to start. Well, honestly, you can watch my videos for free. Be very careful with the influencers because you're going to feel like your brain is spattered against the wall. But if my portfolio can be any realm of, grounding, keep it simple. Only invest in what you understand. I would let ETFs carry you most of the way and then gamble with a small percentage. But if you want to talk one-on-one, go to kylelivingston.com. Link is in the description below if you want to talk one-on-one. I've been doing a lot of those recently, and I appreciate you guys supporting the channel, coming to have a fun personal conversation with me. But otherwise, stay cool, stay awesome. And as always, I look forward to catching you in the next one.